All right, then I would suggest we kick it off. Good morning and good afternoon to everybody. Thank you so much for joining today's webinar. It's a pleasure to jointly with CDP and BCG share our perspectives on navigating sustainability reporting. We are very much looking forward to spend the next 60 minutes to share some of our perspectives, but also obviously to allow for some Q&A and interactive discussions. The way we have set up the session is basically we'll be having 3 subsequent presentations. You are more than happy to put your questions in the chat. You should all be able to see the Q&A functions in Teams. And we are basically planning to address all of those questions once the presentations are over. We are planning to spend approximately 30 to 40 minutes on the presentation part, and that should give us hopefully sufficient time to address most of the questions that you might be having. Before we get started, let me quickly introduce my co-speakers and myself. And with that, Tim, I'm quickly handing it over to you.
Thank you, Yannick. It's a pleasure to be with everyone today. I know that it's a very busy week. I'm here in New York at Climate Week, and if your schedule's like mine, it's pretty packed. So I'm glad you're here with us, and I hope we get into a lot of discussion, as my colleague Yannick said. My name is Tim Mohan. I'm a partner at BCG. I have been around the reporting business for a very long time, from well before I joined BCG. My career breaks down into 10 years in the federal government working for EPA and the US Senate, about 20 years working for big tech, Intel, Apple, AMD, and then I became the CEO of the Global Reporting Initiative before joining BCG. So I've really seen reporting from both sides, from the standard setter side, from the reporter side, and it's changing. So we'll get into a lot of that today, and I'm really thrilled to be with you. Let me hand it off to my colleague Guy to do his introduction.
Yeah, good afternoon, everybody. It's a pleasure to be here with the colleagues from BCG. I'll be talking a little bit about CDP's perspective in light of all these evolving regulations, mandatory disclosures that Tim just mentioned. So it's a pleasure to be here and looking forward to the discussion.
Then thank you so much. Let me conclude the introduction round. Yannick Leindecker, I'm an expert partner from our Munich office with BCG now for the last 13 years. And I represent our Center for CNS Policy and Regulation, which is basically BCG's think tank on everything around ESG regulatory matters, which, no big surprise, obviously is largely centered around ESG reporting at the moment. And building on the 2 introductory presentations, I'll be sharing some perspectives on the type of discussions that we are currently seeing within industries, what are the type of challenges that companies are facing, and how they are trying to address them. But before we get there, Tim, more than happy to hand it over back to you for the introductory piece.
Terrific. Let's go to that slide. As Yannick said, before we get started, it would be wonderful if you could type your questions into the chat. There's a Q&A function. We'll be collecting the questions, and we'll save a bunch of time at the end to have an interactive conversation. So let me start off. My job in this webinar is to kind of paint the picture, the past, the present, and the future of ESG reporting, what we now call ESG. It's had many names: corporate responsibility, sustainability. They're very synonymous, and we can get into that. But it's not a new practice. If you kind of have been around this for a while, you know that more than 95% of the S&P 500 companies are reporting voluntarily some form of sustainability information. So we may have reached peak sustainability reporting. The question is, why all of this interest? Why all the change? And the answer to that is that over that period of time, when all these companies were reporting, it became very evident that there were important information in this report, in these reports, that investors primarily wanted to know. Some of that information is financially material to the company, and investors really need that information. And so you see on this slide the change that is going on right now. there's a subset of information that has been deemed financially material and thus must be reported in financial reports of the reporting company. And that's changed everything. It's called single materiality or financial materiality, if you will. But it gave rise to organizations like the Sustainability Accounting Standards Board, or SASB, which then was merged into the International Sustainability Standards Board, or ISSB. So there's a whole new realm of standards that are focused primarily on the sustainability issues that have material financial impact on the company. That's the new. The part that's been going on for many years, decades in fact, is the double materiality piece, which was really embodied by the Global Reporting Initiative, where I worked for several years. And that continues to this day. In fact, it is also becoming enforced by the European Union. We're seeing the European Sustainability Reporting Standards adopt the double materiality paradigm, and that is going forward. So really, you have these two separate ideas that are out there and starting to really have the force of regulation behind them. And the last thing I'll say on this slide is it's important to note that financial materiality is a subset of double materiality. So they're really supposed to be working together. A lot of people sort of set them apart, but they actually work together. We can go to the next slide. So this slide looks a little complicated, and maybe it is, but it kind of goes through the story that I just mentioned before. So voluntary sustainability reporting has been around a very long time. GRI was founded in 1997, so a very, very long time. That's kind of the outer shell, if you will, where most companies have been for many, many years. What's changing now is that the force of regulation is requiring companies to report on certain sustainability issues in their financial statements. And you're seeing that with this next layer, which I mentioned before, the European Union in their Corporate Sustainability Reporting Directive is now going to require 10,000 companies, 50,000 companies, 10,000 that are outside of the European Union will be subject to mandatory reporting under these new standards, the European Sustainability Reporting Standards I mentioned before, and you can see that on the bottom of this slide. The other piece of it, the financially material sustainability issues will also be required to be reported, and that's just about in every other capital outside of Europe. So you can see in the US, in the UK, in Japan, Singapore, Hong Kong, many other capitals are producing regulations that will require companies to disclose some form of sustainability information. Now, most of that right now is climate, but there will be additional issues added on to climate change as time goes by. So that's kind of giving you the story of how it's gone from voluntary into mandatory and how there's a difference between how the Europeans are regulating sustainability reporting and how other capital markets are regulating the issue. And the last thing I'll say on this slide is there is some commonality. I know it's very complicated, but the commonality is the Task Force on Climate-Related Financial Disclosure, TCFD. Inside of these standards, if you're looking at climate, which is the top of everyone's list, they're primarily based on the TCFD framework, the 11 disclosures in TCFD. So what I often say to clients is focus on the TCFD and you'll be most of the way there in terms of covering the climate disclosure requirements. The other piece of that is the accounting standards, which is the Greenhouse Gas Protocol. Again, that's been around for a very long time. Many people are familiar with it. There's a number of different software companies that are trying to automate that process, but that is the common standard between all of these different reporting requirements. We can go to the next slide, please. And again, please remember to ask your questions in the chat. So this is just a quick slide to kind of give you a sense of the difference between the different capitals. In the US, most people are aware the Securities and Exchange Commission is in the process. They've proposed a new rule and they're in the process of finalizing it to require climate disclosure in financial reports. But as you can see from this quote from Gary Gensler, the chair of the SEC, what they're interested in is consistent, comparable, and decision-useful disclosures for investors. That's all. Whereas in the European Union, by this quote, you can see they're really interested in holding businesses accountable for their impact on society. So there's quite a very different theory of change, a different objective behind these different regulations on either side of the Atlantic. And on the next slide, this is how it's manifest. And so I mentioned that the rest of the world is kind of working on the International Sustainability Standards Board, the ISSB standards, which they have one general standard and one standard on climate. As opposed to in Europe, what you're seeing is a whole raft of standards that is cross-cutting. It's environmental, social, and governance. So you're looking at more than 10 different issues that companies will have to disclose. And most recently, what we've seen come out of Europe is that companies will go through a materiality assessment, again, looking at double materiality, what's important for the company and what's important for the people and the planet around the company, to choose which of these standards are material for them and thus must be reported. So I know it's a lot of complex information. I know I've gone through it fairly quickly. My colleagues will now kind of go through how this is going to work both in the CDP context and within our client companies at BCG. So let me turn it over now to Guy, and again, keep those questions coming.
Thanks, Tim. I'm sharing my screen. Hopefully it will work. I think it should be working now. So just to follow up on Tim's presentation, as rightfully presented, all of these standards, none of them are sort of reinventing the wheel, right? They're all building upon the recommendations of the TCFD, which CDP has fully incorporated into its disclosure framework since 2018. So it's fair to say that companies that have been disclosing through CDP for the past, let's say, 20 years that we've been doing this, they're fairly well prepared for these new mandatory disclosure requirements. As such, CDP has also committed publicly to fully incorporate the new recommendations coming out of the IFRS standards, the ISSB recommendations. So IFRS S2, which is the climate standard emanating from the new ISSB standards. CDP will be fully incorporating those from 2024. And what that means is that we're adapting the questionnaire to include and collect the data points needed from the investor perspective from companies. And the important thing to keep in mind is that companies that have been disclosing to CDP then will be well in advance in preparing and submitting this requirements. In terms of standard setting and interoperability, it's important to note that it's very, very important that in order to avoid the so-called reporting burden to companies, that these standard setters work out on their commonalities. So figuring out what are the terms that they are using, which mean what do they mean, and do they mean the same thing or not, in order to allow what we call this sort of digital tagging or XBRL tagging of information, so that a company that is submitting according to IFRS standards information that is very similar or equal to the information that is requested under ESRS can do it only once and then tag it under different tags. However, only doing it once. So avoiding, let's say, the need to do it twice. CDP is very keen on working with these standard setters on these interoperability, and as you know, CDP is the tool that is used to sort of bring the standards into the real economy. So We're very keen on following up on the current discussions on interoperability between IFRS and EFRAG, and we will continue to collaborate with them on that regard. So in terms of the CDP framework and how it prepares companies, we believe in the so-called building block approach. So these new standards released by IFRS, we believe they are the sort of global baseline in terms of standards. So these are the standards that will most likely, given the track record of IFRS, the very good track record of adaptability and implementation across the global jurisdictions, we believe it will be the same thing with the sustainability standards. So this IFRS S1 and S2 will be the new global baseline in terms of environmental reporting, and whatever jurisdictions decide to implement, they will implement based on this baseline, and then building on it, they will include other specific requirements. It could be that for a specific jurisdiction, some data points are more important than others, and vice versa. So it should be that sort of building block approach that will emanate from this current landscape. And CDP will help the fast implementation of these standards by integrating fully the IFRS S2. So the companies that will be disclosing to CDP will be well in line to adapt to this evolving jurisdictional landscape. In terms of the CDP role within this evolving landscape, we believe that our questionnaire will also evolve to meet the global challenges of this evolving market. CDP is committed to incorporating the most high quality and impactful standards at scale through our disclosure system. So it has been the case in the past when we incorporated TCFD in 2018. We've just announced yesterday that we are also going to incorporate the recommendations from TNFD, so the nature-related financial disclosures, and we will continue to do so. So CDP will continue to be, let's say, the gold framework for sustainability reporting going forward. And it has been the case for the past 20 years, and it will continue to be the case. Even though, and we're very happy about that, the ESRS, as Tim just showed, has a very ambitious, let's say, holistic view of environmental disclosures, and it sort of leaped a little bit forward on some topics that CDP is currently not addressing. But over the next few years, CDP will continue to evolve, incorporate the best practices, and continue to be this gold, let's say, framework for reporting. And as said, the idea is that we build on the best practices. So going forward, we will include the best practices from ESRS and any other jurisdictional mandatory requirements that will emanate from this current landscape. As Tim mentioned, there's the SEC rule in the US, there are standards being developed in Brazil, in China, in jurisdictions all over the world. Whatever it is implemented at the jurisdictional level that constitutes best practice in environmental disclosure, CDP will make sure that we will incorporate those over the next years to continue to bring these best practices forwards. That's our mission. And in that sense, it's very positive. We're very happy about these developments. It's a very important year for CDP with the implementation of the EFRAG ESRS standards, with the implementation of IFRS standards. We're very happy about it, and we will continue to bring forward environmental disclosure and looking at, as I hinted at, with the adaptation to the TNFD requirements, looking also more holistically at other nature-related impacts. And with that, I'm happy to pass it over to Yannick. But just before we close, I wanted to highlight that CDP has already released a mapping to the environmental set 1 of standards, so the climate change standards within ESRS. It's a high-level mapping It is not a very detailed mapping. This is to give companies an idea of what are the points that they've been working on already over these past 20 years of CDP disclosure that they can build upon and then finalize their ESRS compliance. Similarly, we did a same sort of ESRS high-level mapping to ESRS 2, so the general cross-cutting standards that Tim mentioned. And we're due to release further high-level mappings on ESRS E2 to E5 by November 2022. And then lastly, for those of you that would like to contribute to our work at CDP, so my work is actually commissioned by the European Commission, and we do capacity building work for companies. So any feedback that you guys may have, any things that you would like us to address in further presentations are very much welcome. So feel free to scan the QR code and give us your feedback. Last but not least, we will be sharing this presentation with you. So I have included some useful resources for you as well. If you're keen on learning more about these regulations, we've developed a series of different materials on it. And with that, I thank you very much, and I pass it over to Yannick for his presentation.
Thank you so much, Guy and Tim, for the introductions. And let me take it from here. So now we have gotten an initial perspective in terms of where the regulatory landscape with regards to disclosure is evolving. We've been discussing how CDP is preparing for that. And to conclude our presentations, I wanted to shed some light on the type of discussions that we are currently having with our clients. I would assume some of the points will resonate with some of you, and also potential ways to address them. But let me maybe start on the beginning. So especially on the European side, with the extension in scope, so basically making this an ESG or a sustainability debate and no longer a pure climate discussion, we are now seeing companies basically fighting hard to capture information on topics that they did not have on the radar in the past. And obviously maturity levels do differ, but even those companies that obviously have been reporting their ESG performance in the past are now being challenged to basically add additional topics onto their agenda. Second point being, there is a expectation, partially implicit, partially explicitly raised, where ESG disclosure is supposed to evolve to. And there is a close liaison with the existing financial reporting processes, where a time harmonization is expected. So we are coming from a situation where in most companies, the preparation of the ESG report did follow a process, but not necessarily as rigid as the financial reporting process did. So from that perspective, we are seeing some discussions here, how to accelerate, but also to streamline the disclosure process, and also to make sure that the relevant decision-making bodies are being involved. The third aspect closely relates to the remark I've just been making, and this is basically the point around limited and reasonable assurance. So basically, whenever you're talking about your ESG disclosure, you need to think through what an auditable process looks like, and that obviously has certain implications with regards to the standards you're issuing, but also with regards to the processes that you need to implement. Fourthly, and I guess that's not surprising, it's a data challenge. So for some of the ESG topics, data have been around, but for some of the topics, we are just in the middle of the process of getting the methodologies established. We just talked about TNFD, which is likely going to lead to some harmonization on the biodiversity and nature side, but the resulting information obviously still need to be captured. Fifthly, and this is also one of the points that especially the Europeans are currently pushing, but we are seeing similar development in other areas of the world, is that the lens that companies are supposed to take extends well beyond their company borders. And it's really this aspect of taking your entire value chain into consideration that is asking for levers of automation, but also for system integration. And last but not least, it's an evolving field. So we are nowhere in a stable situation where you can basically say that's the standard and off you go. One could argue the Europeans have made a strong push in defining the landscape, but some of you will have seen the ISSB. Yes, they issued their S1 and their S2, but they're already in the process of defining their next priorities. It could be biodiversity, it could be human capital, it could be human rights. So basically, you need to anticipate further requirements to be issued. So basically, it becomes a must-have that you keep track of these changes happening. That's a little bit the, let's say, challenge that we are currently seeing in obviously different forms and different shapes. And what we are typically arguing is there are certain levers you can take to be smart about how to deal with the topic. And let me highlight some of the levers that we are currently discussing with our clients. Obviously, more than eager to get additional impulses as we shift towards the discussion. So on the one hand side, there is a discussion around how to prepare for the REC requirements. And as Tim rightly mentioned, we are seeing this shift from voluntary towards mandatory. So from that perspective, it becomes important that you basically ask yourself, what have I been reporting against in the past? What is the new requirement? And that you basically have a target picture in mind, how your set of KPIs is going to evolve over time. And you might even face situations where you might not be forced to report something, but for legacy reasons, you cannot basically move beyond what you have been reporting in the past. The second aspect, and this is one of the points that's especially relevant for companies impacted by CSRD, is the question around the materiality or the double materiality assessment. Because this is basically, from our interpretation, the key lever you can pull to focus your efforts. And EFRAG, so the standard setting body in the European Union, has basically reconfirmed that perspective. They want companies to take a materiality-based approach. So they basically say, focus your efforts on the topics that are most material to your business, which on the contrary, obviously means do not waste your resources on topics that you do not have a material impact on. So meaning there is a clear lever where you can basically scope the effort you are taking. The third aspect, and this is a discussion we are having primarily with companies that have a global footprint, is basically you need to get your head around how you're dealing with partially diverting local requirements in basically setting up some sort of global minimum or global maximum standard. And the tendency that we're currently seeing, not saying that that's going to be the target status, but as Tim rightly mentioned, TCFD is basically the backbone of all the climate disclosure. So there is quite some rationale to basically make this a sort of mandatory requirement across your operations. More interesting is the question around what are you doing with the add-on requirements that we are seeing at the moment in the European Union? So do you basically ask your entities outside Europe to adhere to that as well? Or what's the right balance to find here? So this is the perspective on the pure, let's say, regulatory side. In addition to that, and I think that's one aspect that cannot be emphasized enough, is the whole discussion around what are the capabilities you need to have in place to basically deal with the requirements on the left. First and foremost, it's a governance question. And for us, this is especially the discussion around clarifying the roles and responsibilities between the Chief Sustainability Officer on the one hand side and the Chief Financial Officer on the other side, because ultimately you still need to basically lead the topic from a content perspective, but you are also dependent on basically getting the expertise from the CFO, how to establish audit-proven processes. And that's something you basically need to specify. You need to have the right decision-making bodies in place, and you also need to define the corresponding interfaces. The second aspect on the business process excellence we've been discussing beforehand. So we are coming from a situation whereby the ESG reporting process lived largely separate from your financial reporting processes. You're now being asked to basically integrate them to the extent possible. Thirdly, we talked about data, and yes, capturing the data is certainly one of the aspects you need to think about, but furthermore, you also need to think about what are the right levers to basically ensure the quality of the information you report against. And to conclude, and I think that's also one interesting development we are currently seeing, it's the question of the technological support. We're having quite a few clients at the moment who are working on, let's say, in-house solutions, basically building their own BI solutions, which is definitely a step worth considering. At the same time, this is also an evolving market where we are seeing different software providers trying to enter the space or who have been there before in the past. And for company, it basically becomes a necessity to navigate, to really make a sort of informed decision. Do we do it internally? Do we go for the external solutions? And there, obviously, also to have some perspective with regards to what's the best fit for your requirements. And with that, let me close our introductory remark. Thank you so much for the various comments and questions we've been receiving so far. And I think, Tim, we can directly get back to you. I think these were the first questions that at least I noted. So there seems to be some interest just to shed some additional perspectives. You talked about the US SEC, but maybe some, let's say, additional perspective. What's your view on how the US regulatory side is going to evolve, given the fact, obviously, that the climate disclosure has been going back and forth? So any additional perspective here would obviously be highly appreciated.
I'd be glad to expand. I mentioned I had a background in government service, and it's quite interesting to see what's going on in the U.S. right now, because we have unfortunately sustainability, now called ESG, has become kind of a political issue in the U.S. And I think most of our attendees and participants know that today. That's created kind of a impasse, if you will, at the federal level. So the Securities and Exchange Commission issued a proposed rule in March last year, 2022. So it's been quite a while. There has been multiple comments, hundreds of comments that have come in, and I think they're carefully working through all of those. But it's because of all the political pressure that's come on. I sense that it's been quite difficult for the SEC to come out with a final rule. Once it does, and that's been scheduled for October, it will be challenged in court. That's 100% likely. And so what happens after that, I think, is anyone's guess. The litigation could go many different ways depending on the content of the final rule. What's interesting is that just over the last few days, California, the most populous state, the largest economy, the largest state economy in the US, has approved two separate laws that essentially would do exactly what the SEC is planning to do in their rule. And it covers all US companies that do business in California if they make over 1 billion in revenue. This is brand new. As of yesterday, the Governor Newsom of California, declared he would sign both bills. And so you're sort of seeing a backstop, if you will. If the SEC can't, or they're tied up in court, or other reasons that the SEC rule does not come forward, you're going to see it in California. Again, there could be litigation in California too, but it looks much more likely that California is going to move forward. And we've seen this before. California often leads when it comes to environmental standards. They have in the past with air pollution in cars, for example. So it's quite an interesting dilemma. I just want to step back for a minute, because we always get kind of wrapped up in the regulatory machinations. Why is all this happening? It's happening because climate change is very real, and it's causing very big effects to companies all over the planet. Investors need this information. Investors need to know where are the risks, and in many cases, where are the opportunities as we go through the energy transition. That's why all of this is happening, and I think it's going to continue to happening. So what I often tell clients is try to step back from the day-to-day, who said what about what, and all the different alphabet soup of standards and regulations, and look at the big trend lines. It's very clear that companies of any size will have to start calculating their carbon footprint, understanding the risks and opportunities that come with that carbon footprint, and reporting on those in their financials. That's the big change we're seeing.
Thank you, Tim. And I just saw another question in the US context, a bit more specific, and maybe I have an initial go, and Tim, feel free to add. So the question is basically when US companies should start adopting the double materiality. So I think two remarks on that one. So I think as Tim outlined, the double materiality is basically a concept that the Europeans are endorsing. So it only becomes relevant for US corporates via two angles. Number one being you have a local European presence above a certain size. So that means your local European business might fall under the requirements typically in 25, 26, depends a little bit on the associated thresholds. Or there is another aspect, and this is a little bit contributing towards the extraterritoriality of the CSRD requirements, which is basically saying non-European companies who are doing a certain size of their business above a certain threshold in the European Union will be asked from 2028 onwards to even report on group level. So these are the two, let's say, mandatory angles that will impact the US corporations. Obviously, from a voluntary standpoint, nobody prevents you from adopting that, but this is at least the legal perspective. With that, we looking in your direction. I think there was a question along the lines of CDP requirements in 2024 and what would be listed, would be required to maintain your A-list status with regards to IFRS and TNFD. Maybe you can take that one.
Yeah, happy to take that one, and perhaps just also to add on the response around double materiality, is that as CDP, we've been very clear about our holistic view on materiality. So we definitely encourage companies to also assess the impact that they have on the planet and not just the impact of the planet on their operations, which is, let's say, the single materiality, financial materiality approach. So we highly encourage, even though, some companies that may be listening in are not based in Europe, it is the best practice indeed to consider a double materiality approach to your assessments. And if you want to stay ahead of regulation, if you want to prepare yourself and your supply chain to what is the best practice in terms of materiality, we highly encourage you to adopting a double materiality approach. EFRAG is releasing its own sort of guidance on materiality, so you feel free, if you're curious about it, feel free to check EFRAG's website, and they should be releasing these guidance sometime soon, definitely before the end of the year.
They already did 2 weeks ago.
They already did.
It's definitely worth a read.
I saw the draft one, and so
yes.
definitely worth the check. And then with regards to the question, I think I haven't heard it directly from my colleagues at CDP scoring, but I would suspect that the CDP approach will be similar to the approach we had in previous years. So when we introduced the new biodiversity module in the questionnaire, we did not score companies to allow them for some period of transition, to allow them to prepare for biodiversity disclosures. So I suspect that any sort of new, totally new topic that is incorporated within the questionnaire should have some sort of grace period. I wouldn't be so sure about the TCFD recommendations or the IFRS S2 because, as said, the TCFD or the newly, let's say, the IFRS S2 is the new TCFD, basically. Right. I mean, it was also announced, I think, addressing another further question that I saw from the audience. It does. So IFRS is, or the ISSB and the IFRS S2 do fully incorporate the TCFD recommendations, and the ISSB will be building upon those. And it has been announced that means sort of the phase out of TCFD with the full set of, let's say, tasks being incorporated by the ISSB, and the development of new standards will build upon all of this. So to say, I would believe that some of the questions that the CDP questionnaire will be bringing in 2024 will build upon these questions, so they won't necessarily be all new to companies. So it could be that they're scored. So, but I think there's no final say on it yet. There's a lot of work being done for this alignment to happen in 2024. So stay tuned. Also because we will be announcing some news on our platform relatively soon. So please stay tuned. Keep checking in on our website because there's some really exciting things coming your way.
Thank you. And I think you already touched base on the third question that we got indeed on the TCFD tracking part. Maybe just one additional remark here. So at least what we've been hearing so far is, you know, TCFD has been issuing their annual report along the lines of adoption, etc. So to our understanding, that will continue at least for another year under the ISSB flag. What happens afterwards is obviously to be seen, but at least that's sort of what we've been sort of hearing on that front. Then moving on, I think there was a question on along the lines of software and data aggregators, and maybe let me have a first go at this one. And Tim Gui, please feel free to step in. So I think the type of discussion we are seeing is it's quite an interesting phenomenon, right? Especially as quite a few vendors are aggressively pushing into the market. What we are currently sensing is, and this is more like let's say an observation and less of a recommendation, quite a few companies are currently thinking about going for the internal in-house solutions first. So basically, they have their BI solutions, building their reporting interfaces. And largely, they explain that with regards to the currently poor data quality. So the sort of arguments that we keep on hearing are more along the lines of, we need to do our homework first. There is not much point having a professional vendor on board yet. Let's first get the data sources right, and let's have the discussion with, let's say, 1 or 2 years down the road. I mean, I'm not saying that's necessarily the right thing to do, but it's at least it's a pattern that we have been seeing across industries, how to address the topic. Then moving on, I think. Sorry, yes, Tim, please go ahead. Sorry.
So, you know, taking again the big picture, carbon is a data problem primarily. There's very few scenarios where you're measuring greenhouse gas emissions, maybe methane and a few others, but for the majority of companies, it's a data problem. So you're extracting information from the enterprise, such as travel, supply chain transactions. Then you're applying the greenhouse gas protocol, which is the accounting rules, and then you bring in the emission factors. That is all being automated now. So we're seeing a bunch of new software companies come into the market and automating that process, which unfortunately for many companies had been done manually for years. And so that automation is incredibly important because, as we've been talking about through this entire webinar, what we're seeing is this information, that is greenhouse gas emissions information, is now getting incorporated into financial disclosure. So just to keep up with the schedule, you have to have automation, but then you also have to have reliability. And so you have to be able to assure that information. It's a very difficult thing to do, but the software industry is stepping up, and you're seeing many different competitors in the carbon accounting market and the carbon disclosure market trying to help companies with this incredible problem. On the other side of it, it's where does that data go? Is it used by the board? Is it used by executive team? Is it collected by nation states or the UN? All of those are true. And again, I think you're seeing a number of different activities like the Net Zero Public Data Utility, which is getting started now to collect all of this information and put it to good use. So a lot is happening on the data side, both in the private market and in terms of national interest. So.
I'm seeing 2 further questions, which I would see more as a sort of, let's say, slight extension of the previous scope, but I think happy to have a quick go at them. I think the first question is around CS3D, so the, let's say, planned human rights legislation on European level and how it basically ranks with regards to the competing, let's say, disclosure requirements. So maybe a quick thought on that one. So I wouldn't not necessarily force them into a ranking, but it's true the type of discussions that we are currently primarily seeing are around the European reporting standards, at least with our European colleagues. ISSB, I mean, it's evolving. We have seen some nation states who have already indicated they will basically shift towards the ISSB, but usually they are the ones who have already made TCFD mandatory. So meaning the step change on that side is rather marginal. CS3D, as you know, is basically still in the negotiation stage. So we are not having a final sort of response yet. It's quite interesting that at least when we talk about the topic of workers in the value chain, so what is being asked for as part of CSRD and ESRS, they do to speak with one another. And just reflecting on the experience we've been having in the German market, where we have a similar law called the supply chain due diligence requirement. Ultimately speaking, it turned out to be a topic largely driven, interestingly, by the procurement department. So you basically saw them issuing questionnaires, additional due diligence levers to check their suppliers. So that would also be our expectation at the moment. Interestingly, the Europeans are expanding the scope. So it's not just a human rights discussion for them. They're also expanding it towards the environmental topic, but that it's basically a vehicle which is likely to be driven by the procurement departments. Would at least be my perspective. But Tim Gui, I'm happy to shed any additional thoughts from your side on this very, very, let's say, specific one.
Yeah, it quickly transcends beyond the climate topic, which we're speaking mostly about today, and gets into labor and human rights across the supply chain. Very, very important issue. And I think Europe, wow, there are so many new directives and regulations coming out that even those of us who follow it very closely can get quite confused about all of them and how they fit together. But this new due diligence directive will have massive effects across many companies.
And I think we've got a similar one, and let's see whether we have got the right audience in this call, which is also another. Sorry, go ahead.
Sorry, just to add on the CSDDD, yeah, definitely we think this approach, and I mean, kudos to the Commission. As Tim mentioned, there's a lot being done by the Commission, this Commission on it. So very progressive Commission, really outstanding work on climate, bringing forward a lot of topics that have been, let's say, in the closet for many years and finally pushing them through. So big kudos to the Commission for doing that. On the CSDDD, I think just to say, I couldn't miss the opportunity to say, I mean, we at CDP, we have a program called the CDP Supply Chain Program, where companies can request their suppliers on a set of different, let's say, requirements, and those are heavily used by our clients in procurement processes. So maybe one way that you could start preparing for it would be, you know, starting assessing whether or not would be interesting for you to get into the CDP supply chain program that can really leverage a lot of the data and leverage the framework that CDP provides to companies to collect this data.
Right. I think I see two further questions. One around applicability for US corporations. So typically it's two drivers happening, right? One being, do you have legal entities in the European market? As simple as that. And the second one basically being looking into your revenue share within the European Union. And these are usually the thresholds that you would need to evaluate. There's another one, and Tim Gui, looking in your direction on the ESG rating perspective. I mean, that's a little bit out of today's scope. But at least from what I have seen, Europe is indeed one of the front runners here. I wouldn't be able to comment whether we have seen that much, let's say, concrete suggestion in other markets, but it's indeed interesting what the Europeans are thinking here to basically, let's say, try to standardize the market or the market practices to a certain extent. Yeah? But you, Tim, happy to step on this one if there are any specific views or thoughts on this one.
I think there'll always be a market for analytics, rankings and ratings, benchmarking, that kind of thing. There's been quite a bit of, let's say, controversy about the ESG analytics market, because some companies get very frustrated because they might be ranked high on one and low on another with the same set of facts. Really, it comes down to the methodology. As we've been talking mostly about climate today, we've edged into many other topics. If you look at the Global Reporting Initiative, for example, there are 33 different standards. It's a massive amount of topics. So it really depends on what you're going to rank in these analytics to see whether or not your company is going to be high or low. I have heard some rumblings, if you will, that the global sort of regulator association, IOSCO, that focuses on capital market regulation, has said publicly that they're going to look into how to bring some standardization to the analytics market. But until they do, I think you're going to continue to experience this situation where you can almost get any answer you want from the analytics. But if you dig a little deeper, most of those answers are based on an algorithm that essentially prioritizes or gives more weight to one or the other of the ESG issues underneath.
I see that my colleague Pietro Bertazzi, our Global Policy Director, has just shared our policy paper on it. So I would just encourage companies to go through it. That's our official position on it. So I cannot say it better than what it's written on the policy document. So please do refer to that one.
Right. I hope I have not missed out on anything, but I hope we have been able to address all of the questions. And thank you to the audience for being so engaged, at least in the chat. That's highly appreciated. Obviously, if there are any questions afterwards, we are more than happy to follow up. And I guess looking to my two co-presenters, I guess we are good to conclude it with that. And thank you much for your time and your attendance. Highly appreciated.
Thank you.
Indeed, it's a true pleasure sharing the stage with you both. Thank you so much. Thank you all for your time this afternoon.
Thank you. Bye.